Hi guys, my name is Stephen Chambers, and today I want to educate you on how high-income earners at Shell could be missing out on maxing out their Provident Fund. Let's start with the contribution limits. If you're below age 50, the employee contribution amount is $22,500. Above 50, it's $30,000. When you factor the employer portion, the max is $66,000. Above 50, $73,500. For purposes of today's video, I want to focus on the employee contributions. Let's look at an example. June is 57 years old. Her total compensation is $600,000, which is inclusive of her base and bonus. Keep in mind, this $600,000 does not include performance share income. June wants to make sure she's on track to maxing out her 401k contributions through her paycheck deductions. So what does she do? She says, okay, 30,000 is my limit. I'm making $600,000. 30 divided by 600 is 5%. Simple enough, right? Wrong. If June sets her contributions to 5% based off of her income for 2023, the employee contribution amount will only be $16,500 for 2023, not $30,000. Why is that? It's because of the IRS 415 limit, which states that you can only contribute on the first $330,000 worth of income to your 401k. As soon as you exceed that limit, which for 2023 is $330,000, the IRS says you can no longer contribute, you nor the employer. The dilemma is ensuring that you max out the 401k prior to reaching this $330,000 limit. In June's case, by just setting it at 5%, she's actually leaving money on the table, about $13,500 worth of contributions, which, because she's in the top tax bracket, equates to a missed $5,500 tax deduction in 2023. So what should she have done? By knowing what the IRS 415 limit is, knowing what the contribution limit is, June should have set her contribution amounts to 9%. But here's the dilemma. These numbers change every year, right? So we help clients determine what the numbers are and what their formula should be to ensure that they're maxing out the employee contributions and taking the full tax deduction. Here's my challenge for you. Log on to net benefits, under summary statements, and run a report for previous year's data to see if you've maxed out your 401k contributions in previous years. A surprisingly number of people actually did not, right? So that's my challenge for you. Here's an actual client example. I pulled his statement during our call and I noticed right at the bat that his company contribution amount was $33,000, which told me that he had exceeded that $330,000 limit early on in the year. As a result, his employee pre-tax contributions were frozen at $8,200. Which means he missed out on about $22,000 worth of employee contributions, which resulted in a missed out opportunity of about a $9,000 tax deduction. So unfortunately, there's nothing that we can do for him in 2023. That die is cast. But for 2024, we're going to ensure, based on what the limits are, that we're maxing out the employee pre-tax piece and getting the full tax deduction. And honestly, that's the advantage of working with Willis, Johnson & Associates. We stay abreast on these limits, and we're making sure that we're maxing out the employee piece to the 401ks each and every year. $22,000 each year and a $9,000 tax deduction over the next 5, 10, 15 years can be a huge difference in accumulating substantial wealth for you and your family. Well, guys, if you like this content, click in the link in the description to watch our free on-demand webinar on how to maximize your Shell benefits. You can also follow us on LinkedIn or Facebook, or scan this QR code to follow me directly. Thank you for watching.